It's 2025. Markets are flying high. AI stocks are exploding. Everyone's making money, until they're not. What if I told you this market boom isn't what it seems? Welcome to the truth behind the 2025 market bubble. You might not like what you hear, but you need to know. In the next minutes, we're breaking down the anatomy of the 2025 market bubble, what caused it, who's profiting, and how it could all come crashing down. But this isn't just doom and gloom. You'll also learn how to position yourself smartly, survive a correction, and maybe even thrive when the dust settles. Let's rewind to early 2023. The global economy was recovering from post-pandemic chaos. AI breakthroughs reignited excitement. Central banks, after years of tightening, began signaling a more dovish stance. Money started flowing again. By 2024, tech stocks were rallying like it was the 1990s. Retail investors piled in, driven by TikTok traders, Twitter threads, and YouTube gurus. Meme stocks made a comeback. Crypto soared. Even niche sectors like EV batteries, quantum computing, and clean energy began seeing wild valuation jumps. Then came 2025. The market didn't just rise, it melted up. Valuations detached from reality. Startups with zero profit traded like blue chips. IPOs were oversubscribed 100x. And Wall Street? It cheered it all on. But something felt off. And for those paying attention, the signs of a classic bubble were everywhere. Here's where it gets dangerous. Bubbles aren't always easy to spot from the inside, but in hindsight, they're obvious. The 2025 market shows the textbook signs: exponential price increases, euphoric sentiment, new paradigm narratives, and increasing leverage among retail traders. Sound familiar? Investors believed AI would reshape every industry overnight. Valuations of companies with zero earnings were justified by vague potential. And like in every bubble, skepticism was punished. Financial influencers pushed FOMO over fundamentals. People mortgaged homes to buy tech stocks. Brokerages offered margin like candy. Everyone believed they were geniuses until they weren't. And while tech stocks exploded, other sectors started cracking. Commercial real estate faltered. Small cap earnings missed expectations. Still, the bubble kept inflating, because bubbles feed on belief. The media? Obsessed with 24/7 green candles. Analysts revised price targets weekly. Economists warned quietly, but no one wanted to hear it. Why ruin a party with facts? Here's the truth. The higher we go without a foundation, the harder the fall. So what exactly causes a bubble like this? Bubbles form when asset prices rise rapidly, far beyond their intrinsic value, driven more by sentiment than substance. They're emotional engines. Greed, fear, and the herd mentality rule. In 2025, three major forces combined to create a perfect bubble storm. 1. Technological euphoria. AI, robotics, and synthetic biology promised a new world. Investors priced in future decades of growth today. 2. Cheap money revival. Central banks flirted with rate cuts to stimulate sluggish economies. That created another liquidity surge, sending money right back into risky assets. 3. Mass retail participation. Platforms like Robinhood, eToro, and zero-commission trading apps made markets gamified. And with social media, bad ideas spread faster than good data. Psychologists call it the greater fool theory. Investors buy overpriced assets hoping someone even more optimistic will pay more later. And it works, until the fools run out. But there's another twist. AI itself is part of the bubble and the bubble creator. Algorithmic sentiment analysis, automated trading bots, and LLM-driven financial advice amplified trends beyond human speed. It's like throwing gasoline on already speculative fires. What's scarier? Many investors don't even realize they're in a bubble. To them, it's the new normal. Let's look at some real-world examples in 2025 that mirror history. Case Study 1. AI Gen X Corp. A startup in the synthetic AI voice space saw its valuation jump from $300 to $40 in 7 months, without releasing a single profitable product. Its stock was meme-ified on social media, driven by viral TikToks and influencer hype. When short sellers raised questions, they were labeled haters. But Q2 earnings showed massive losses. The crash was swift and brutal. Case Study 2. Bitverse ETF. This blockchain-based AI DeFi ETF ballooned in value as influencers hyped it. Retail investors dumped savings into it, believing it was too advanced to fail. When regulatory news hit, 70% of its value evaporated in 3 days. Mini story. The 24-year-old margin millionaire Jake, a 24-year-old TikTok trader, turned $10K into $2 million by YOLOing options on AI stocks. He went viral, sold courses, and became a guru, until one bad trade wiped him out. He's now back to zero, but still posting. These aren't just anecdotes, they're warnings, and they echo .com 2000, housing 2008, and crypto 2021. Different assets, same psychology. So what can you do about it? 1. Don't chase hype. If you hear it on social media, it's probably already overpriced. Ask, would I still buy this if no one else knew about it? 2. Check fundamentals. What does the company actually do? Is it profitable? Does it have real customers? 3. Diversify. Smarter. Hedge exposure. Include defensive sectors like healthcare, consumer staples, or commodities. Bubbles usually pop unevenly. 4. Watch the Fed. Central bank policy can trigger or deflate bubbles. Stay informed on macroeconomic signals. 5. Set exit triggers. Decide your profit-taking strategy now, not when you're emotional. 6. Learn from history. Bubbles follow patterns. The more you study past crashes, the better you can anticipate this one. And finally, stay emotionally detached. Investing isn't a popularity contest. It's survival of the most rational. If this felt like financial therapy, it kind of was. Bubbles are thrilling, terrifying, and oh so human. But remember, you don't have to go down with the hype. Stay sharp, stay skeptical. And if everyone around you is partying like it's 1999, maybe it's time to quietly head for the exit. And hey, if the bubble doesn't burst, great. You'll still sleep better knowing you're playing chess while others are playing roulette. Like, share, subscribe, and keep your wits in the wild world of markets. See you in the next financial freakout.